Hey everyone, and welcome. Today we're going to get a handle on a problem I see all the time: investing without any real plan. You know, when you buy a mutual fund just because you heard it was hot. Well, this talk is for you. We are going to turn that random approach into a super clear, powerful strategy. Okay, let's get into it.
So, does this hit close to home? You're putting money aside, which is fantastic, but there's no real rhyme or reason to it, is there? It can feel like you're just throwing darts in the dark, really hoping one of them hits the board. Look, most of us have been there, but the good news is you don't have to stay there.
And this slide just lays it out so perfectly. On the one hand, you've got the chaos of random investing. It's vague, it's stressful, and who knows what'll happen. But on the other hand, you have goal-based investing. It's clear, it's purposeful, it's all about making sure every single rupee you invest has a very specific job to do. All right, so how do we actually make that jump? Well, it all starts right here. In this first section, we're going to learn how to turn those fuzzy financial wishes into solid, actionable goals. Seriously, this is the foundation for everything that follows. Check this out. It's such a simple distinction, but it's a total game changer. My child's education. That's a beautiful sentiment, right? But it's not a plan. It's a wish. A goal, though, that's specific. It's got a number attached to it, 25 lakh. And it's got a deadline, 15 years. Now that is something we can actually build a plan around. So it really boils down to this incredibly simple three-part formula. Any real financial goal has to have a purpose, an amount, and a time frame. What's it for, how much do you need, and when do you need it by? If you can answer those three simple questions, you have officially graduated from wishing to planning. But hold on. There's a little trap hiding in that amount part, isn't there? The costs of things, well, it doesn't just sit still. This is where a sneaky little thing called inflation enters the picture. And trust me, it can have a huge effect on our long-term goals. So let's just stick with that education example for a second. Imagine the degree costs 10 lakh rupees if your child was starting college today. It's so easy to see that number and think, okay, that's my target. But we're not planning for today, are we? We're planning for the future.
And boom, look at that. In just 15 years, that same 10 lakh education could cost nearly 30 lakh rupees. Now that is the brutal power of inflation at work. And this is exactly why it is so important to plan for the future cost of your goal, not what it costs right now. Okay, deep breath. We've got our goals, they're specific, they're time-bound, and we've even factored in future costs. Now we get to the really fun part, connecting those goals to the right kind of investments. This is where the strategy truly comes to life.
But wait, before we dive in, let's just pause and call out the single biggest mistake that almost everyone makes. They pick the fund first, and then they try to figure out what that fund is for. We are going to flip that completely on its head. The goal always, and I mean always, comes first. Now this chart, this is the heart of the whole strategy. It's so simple. Think about it. For short-term goals, like maybe a down payment you need in 2 years, what's your priority? It's safety, right? You can't afford to lose that money, so you'd look at things like debt funds. For those medium-term goals, you're looking for a bit of a balance between safety and growth, which is where hybrid funds come in. And for the really long-term stuff, like that education fund 15 years away, you need growth, and that's where equity funds are designed to shine.
Now, retirement is kind of the ultimate long-term goal, isn't it? It's probably the longest and most important one you'll ever have. The strategy here needs to be smart and adapt over time. You start out focusing on growth, probably with equity, when you've got decades to go. But as you get closer to that finish line, you slowly and carefully start shifting your money into safer options, like debt, to protect everything you've worked so hard to build.
So, how do you make all of this happen without driving yourself crazy? How do you put it on autopilot? Well, the best tool for that job is usually a systematic investment plan, or an SIP. It just lets you invest a set amount automatically, every single month. It takes the emotion out of it, keeps you disciplined, and helps you build wealth nice and steady. Okay, we have covered a lot of ground, from dreaming up a wish to defining a goal and even mapping it to a specific type of fund. So let's bring it all home. Let's talk about the one single golden rule I really want you to take away from all of this today. This right here. This is the transformation we've been working towards. You can move from that feeling of random, stressful investing to a place of structured, purposeful planning. You're not just guessing anymore. You are in the driver's seat, executing a clear plan that's built just for you. And here it is. This is the golden rule. If you forget everything else, please remember this. Don't start by asking, which fund should I buy? Start by asking, what am I saving for? I promise you, once you know your goal, finding the right investment becomes so much easier and way more logical.
And of course, just a quick and important reminder that all of this has been for educational purposes. Mutual fund investments are subject to market risks, and it's always a really smart idea to talk with a qualified professional before you make any decisions. Thanks so much for joining me.